Hi, I'm Jenny Brown and welcome to our weekly buy-to-let mortgage market update. I hope everybody's doing really well. I don't know about you, but I was really pleased to see the first signs of spring starting to inch their way forwards. There's some snowdrops up in our garden, which is really, really nice to see. This week, what we've got for you is our lender update to give you the news on what the lenders have been up to in the last week. We're also going to be sharing with you some market data in relation to both house prices and also rental income. And we've also got some information on new rules on letting property. So first of all, with the lender update, so Foundation Home Loans has cut the rate on some of its 5-year fixed rates by up to 10 basis points. They now have 5-year fixed rates starting from 3.34%, and these are available to both individual and limited company borrowing. Some USPs for Foundation: they have no minimum income, they don't mind how many properties you have in the background. Their maximum age on maturity of the loan is 85 years old. And whilst one applicant would need to be at least 21 years of age or over, they are able to accept a second applicant who is age 18 or above. And that's quite unusual for lenders. They tend to want everyone to be at least 21, or in some lenders' cases, actually 25 years old. We've also seen in the last week NatWest cut their rates, and they now have pricing starting from 1.6%. Now, in terms of NatWest as a lender, they have a fairly restricted policy, I would say. So they're great for landlords who have just one or two buy-to-lets and an income of over £25,000. They're certainly not going to work for our landlords who have larger portfolios or anyone who is really reliant on just property for their income. Now, NatWest are, when I think about them, I really do always come back to the point that they are really good at unusual property types. So ex-local authority, unusual construction, so example, wimpy no fines construction. And also they're really great for those flats over commercial, particularly good at restaurants and takeaways. So they will take on certain properties that other lenders will not. Now, in addition to, if I'm being perfectly candid, some really good pricing on remortgages, they also offer free valuations and free legals. So really great to see them come into play with some good rates. I just wish they'd loosen up their criteria a little bit. We've also seen West One come back into the holiday let market. And the pricing starts from 4.34% at 70% loan to value on 5-year fixed rates. Now, they'll not only just lend on standard properties, but also on multi-unit holiday lets as well, which is fairly unique. Now, what they will do is, rather than using the income that the property would receive on a holiday let basis when looking at affordability, they're going to be using a standard AST rental income. So that won't always work for all properties, particularly for those properties which are in areas which are fairly high value to buy in, but wouldn't rent out for a large amount of money. And I've given this example before, but somewhere like Salcombe in Devon, where the house prices are very high, holiday letting income very high, AST rental income not so good. But they will also absolutely work for different properties in other parts of the country. Now, for accessing the holiday let mortgages with West One, they will accept first-time landlords, but you do need to be a homeowner. They don't mind how many properties you have in the background, so professional landlords who are looking to diversify their portfolio and seize upon the staycation year that we're looking at facing this year. These could be good for you. They also don't have a minimum income requirement. Now, West One are a lender who are good with property types. They're fine with high-rise property, flats in high-rise blocks rather, ex-local authority, and they're also able to lend to individuals, LLPs and limited companies. So really good to see those guys coming back into play in the holiday let market, which we think is going to be really big this year. Now, we've also seen Barclays clarify their position on UK nationals, or particularly EU citizens, looking to apply for a buy-to-let mortgage. And what they're saying, that applicants without permanent rights to reside or settled status are not currently eligible for Barclays buy-to-let mortgages. And this is across the board. So lenders tend to always, in the buy-to-let space, I say always as a rule of thumb, want to lend to those people who are here permanently. And so it's quite normal. They're just kind of aligning their policy to really sit alongside the changes that are in place as we've left the European Union. Now, if you're looking at residential mortgages, it is quite different. So lenders are much more open to looking at visa arrangements. So people who are here on a visa, lenders are much more open to lending to you on a homeowner basis. It really comes down to the type of visa that you are on and how long is left on it. Now, we've also seen Virgin make a change to their lending policy, which is around the rental calculation, which they are using when assessing affordability on a buy-to-let. And what they've done, I won't go into the details, but they've essentially made it more onerous. So they've kind of scaled back slightly how much you can borrow per pound of rental income. I can't really necessarily gauge exactly why they have done that. They may have just reviewed their proposition and decided that they felt they were being a little bit too laissez-faire. It wasn't exactly crazy generous in the first place, but maybe that's what they have done. But I think there's nothing to really read into this. I don't expect other lenders to be, following suit. I think it's just Virgin making an amendment to their policy. Now, Gatehouse Bank, who offer Sharia-compliant mortgages, have made some reductions across their buy-to-let range, including on their HMOs and multi-unit block products, of up to 61 basis points. Now, Gatehouse Bank are a lender who are quite unusual. So first of all of their mortgages are Sharia-compliant, which is great. Now, they're able to lend to expats and international applicants. They're able to lend to limited companies, LLPs and individuals. And all of their products do not have an early repayment charge. So none of their products come with this, and that's all part of the product being Sharia compliant. So they have quite an unusual offering, but it's actually really quite good. I think it's fair to say they're probably not the easiest lender to deal with, so this wouldn't be a lender you'd want to go to if you were in any kind of rush. But what they do offer is fairly unique, so definitely one to keep in the back of your mind. Now, I'm delighted to say that Shawbrook have introduced an 85% mortgage product. So that's the first one back in the market. Now, this is for refurbishment projects, okay, and it's actually a very exciting new offering. So what they're saying is that they can lend up to 75% loan to value across most of their product range and up to 85% loan to value on residential buy-to-let properties when lending for refurbishment costs. So they can lend up to 100% of the refurbishment costs, but the loan cannot exceed 85% of the purchase price or day one value, or 75% of the post-works value, or GDV as it's also known, so it's whichever is lower. So the rates start from 0.5% per month. They can consider loans between £50,000 and £15 million. The 85% loan to value is available with terms of up to 24 months. There's no minimum interest or early repayment charge period as well. So this is a bridging loan. It's really designed for those people who are looking to acquire property, do some works to it, and then you can either look to refinance with Shawbrook or elsewhere, or sell the property on. But the key is that you can really gear up on this type of arrangement to help cover your refurbishment costs. Now, lastly, just sticking on the news, not so much lender news, but just the wider market for a moment. The stamp duty holiday extension, which we talked about last week, was discussed in Parliament on Monday. And it does seem to have wide support across the MPs, but we're not expecting to hear any more news on this now until the budget on the 3rd of March. So obviously, if we do hear anything in the meantime, we will keep you posted. But yeah, it's looking like it was well received and very well supported. Now, just keeping in mind the stamp duty extension debate, some news here that might be fairly relevant to you if you're looking to complete on a property within the stamp duty deadline. So it's been announced that the amount of time it takes to sell a home in the UK has jumped from 96 days to 124 days, and that's due to delays caused by the pandemic. So this 29% increase in time it takes to exchange contracts is due to delays with property searches and conveyances, leading to a backlog of data cases, and that's according to data from property sales intermediary MoveWise. Now, this firm also added that any property that went under offer from late November 2020 onwards may well struggle to complete before the stamp duty deadline on the 31st of March. Now, they have caveated this, saying that actually delays across the country do vary depending on which region you're actually in, but it's worth just keeping that in mind. And also, therefore, I think that really just comes back to being very, very mindful about this potential stamp duty extension and what that's going to look like if and when it lands. Now, Nationwide have just published their annual house price index, and it's showing that annual house price growth has slowed for the first time in 6 months, and it's the end of the stamp duty holiday approaches. So the data shows that in January we saw the annual rate of house price growth slow to 6.4%, and that's down from 7.3% in December. I went on to say the house prices fell by 0.3% month on month after taking account of seasonal effects, which is the first monthly decline since June. Now, I think we're going to be watching this very, very closely. We've always thought that we would start to see a slowing down of house price growth at this point in the year with the stamp duty holiday coming into close. I'm still not worried that we're going to see things fall off a cliff, but I think, we really are starting to see the signs of things slowing down. And actually, conversely, what I'm starting to see is a lot of my landlord clients who are not ones who like to buy in frothy markets because they don't like to feel they're overpaying for property. They're starting to really come out to play again, looking to make inquiries and looking around at further investments. So yeah, we'll keep our eyes on that, but hopefully we're not expecting to see things tank by any means. Now, a little bit of letting news, which I have to say filled my heart with absolute joy. As some of you will know, I'm a huge dog lover, and I'm a big believer in letting tenants have pets in properties. I've always let my tenants have pets in my rental properties that I let out. And so we've had some news last week that responsible tenants with well-behaved pets will be able to secure leases more easily through the new model tenancy agreement, which was announced by the government on the 28th of January. So under the new model tenancy agreement, which is announced by Housing Minister the Right Honourable Christopher Pincher, landlords will no longer be able to issue blanket bans on pets. Instead, consent for pets will be the default position, and the landlords will have to object in writing within 28 days of a written pet request from a tenant and provide a good reason as to why they cannot have the pet in the property. Now, I've seen quite a lot of debate about this, actually. Like I say, I've always allowed my tenants to have their pets in their properties. I'm a dog lover, so of course, that's going to be something that I'm quite keen to support. There have been some people with real horror stories with regards to, people's dogs trashing, chewing carpets and stuff. And understandably, that would be a reason not to allow a tenant to have a pet in the property. But likewise, also there brings in some debate around if you have an HMO with, say, 8 tenants and each person's got a dog, having 8 dogs in a property walking around would be very difficult. So I'd imagine that what will be applied is some real common sense as to what is appropriate with regards to having a pet versus the actual environment the pet will be kept in. But yeah, I think that's really good news, and it'll be really obviously a massively good bit of news for tenants who don't want to have to give up their pets just to be able to rent their home. And lastly, just to wrap up with some rental information. So estate agents reported that 30% of landlords increased rents last month, and that's according to data from Arla Property Mark. Now, this compares to 28% of landlords increasing rents in November, and that was the first time the figure had risen in 4 months. I know there was a lot of talk about landlords seeing their rents coming down at the start of lockdown, so it's really encouraging to see that things are starting to go back in the right direction. I know that I just put one of my buy-to-lets back on the market. Reassuringly, not only did the rent go up, but actually the property rented quite literally within a matter of, I think it was 3 days. It hadn't actually even gone to being advertised, and it was taken. So really good news. So I think actually what we're seeing is that by and large, the rental market is still holding incredibly firm, and it's a really good place to be. That's everything from me this week. Thank you, as always, for giving us your time and joining us today. If you do want to give us a call, we'd be delighted to have a chat with you, 0345 345 6788, or have a look on our website, mortgagesforbusiness.co.uk. Until next week, do look after yourselves, keep warm, keep dry, and I will see you again next Wednesday.